Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
We talk a lot about, all the success stories in business, the growth and the market dominance.
Right.
But, realistically, sometimes things don't quite go to plan.
Yeah.
Sometimes a company hits a rough patch, financially speaking. So today, we're going to dive into a topic that's super important, but maybe doesn't always get the attention it deserves. Corporate turnarounds. We're going to explore how companies navigate their way back from those really choppy waters, back to a place of stability, and, maybe even set themselves up for even bigger wins down the line.
Exactly.
And it's not just about putting out fires, right? It's about understanding those early warning signs, before things get really out of hand, and then having the right strategies in place. And of course, the finance folks, they play an absolutely critical role in all of this, especially when the pressure's on.
Yeah, absolutely. I mean, the stakes are so high in these situations.
For this deep dive, we've pulled together a bunch of materials really focusing on those core areas: corporate finance, the ins and outs of restructuring, the nitty-gritty of cash flow management, and we've got some really interesting real-world examples of companies that have gone through this whole turnaround process.
Yeah, some great case studies to really illustrate these points.
So our goal today is to really give you a solid understanding of the financial side of corporate turnarounds. We want to go beyond the surface level and give you some practical insights that you can actually use.
Those takeaways that really stick with you.
So let's get started. Where does this turnaround story usually begin? I mean, it's probably not some sudden catastrophic event, right?
Right. It's usually not like a light switch, on and off.
It's more like a gradual process.
It is. It's often more subtle, like those early tremors before, a larger event.
Okay, so let's talk about those tremors. What are some of the less obvious signs of financial distress that a sharp finance team should be on the lookout for?
Well, one key indicator is a decline in gross profit margins. If you're selling roughly the same amount of stuff, but you're making less profit on each sale,
Yeah.
that's a pretty big red flag. It might mean your competitive edge is slipping, or maybe your input costs are going up. It definitely signals that it's time to take a close look at your pricing strategy and how efficient your supply chain really is.
So essentially, the alarm bells should be ringing if you're working harder but not seeing the financial rewards.
That's right. And then there's the issue of negative cash flows. A healthy business usually brings in more cash than it spends,
Yeah.
over the long run, of course. But if that pattern flips, and you're consistently spending more than you're bringing in,
Uh-huh.
that's a major cause for concern.
Yeah, makes sense. I mean, if you're constantly burning through cash, that's not sustainable.
No, it's not. It's like having a leaky bucket. You can only keep pouring water in for so long.
Right. So we've got declining margins, negative cash flow. What are some other financial metrics that should be raising those red flags?
Well, another crucial one is a rising debt-to-equity ratio. If a company keeps relying more and more on debt to finance its operations, instead of using its own equity, it becomes a lot more vulnerable, especially if those dreaded interest rates start going up or if their profits take a hit. A high debt-to-equity ratio, it not only makes the company riskier, but it also makes it harder for them to borrow money in the future.
Oh, I see. So it's like a double whammy.
Yeah, pretty much. They might be forced to sell off assets or try to raise more equity, and those aren't always easy options.
And then there are those more blatant signals, right? Like when a company starts delaying payments to suppliers or breaking the agreements they have with their lenders.
Yeah, those are definite red flags. If they're consistently delaying payments or, even worse, violating those loan covenants,
Yeah.
that could trigger all sorts of problems like lenders demanding immediate repayment, and that can really put a company in a bind.
Right. It's like a domino effect.
Exactly. And it's not just the numbers, the financial statements that tell the story. There are also those non-financial indicators that can give you a clue that something's not quite right.
Okay, so we're going beyond the balance sheet and income statement now. What are some of those less obvious warning signs?
Well, think about it. If there's a lot of turnover at the top, frequent changes in leadership, that could be a sign of instability. Maybe they don't have a clear strategy, or they're just struggling to find the right direction.
Yeah, it can definitely create uncertainty within the organization.
It does. And another one is employee morale. If people aren't happy at work, if morale's low, that's going to affect their productivity and ultimately the company's bottom line.
It's all interconnected, isn't it?
It is. And then there's customer churn. If customers are leaving, that's a direct hit to your future revenue. Think about it. If the phrase burn rate starts popping up in every meeting, every week, that's usually a pretty clear signal, even if it's not a financial metric, that things aren't moving in the right direction.
Yeah, it's like the whole vibe of the company starts to shift.
Exactly. It's a more holistic view, looking beyond just the numbers.
So let's say a company starts seeing these red flags, both financial and non-financial. What are some of the key strategies they can use to try and turn things around?
Well, it usually involves a multi-pronged approach. One big area is operational restructuring.
Okay.
Sometimes that means making some tough choices, like getting rid of parts of the business that just aren't performing well, those units that are dragging down the whole operation.
Hmm.
They might also need to completely rethink their cost structure to become more efficient.
That sounds like a pretty massive undertaking.
It can be, but sometimes you need to make those big structural changes to survive.
What about the overall direction of the company? Does that ever need to change as part of a turnaround?
Absolutely, that's where strategic pivoting comes in. Sometimes the core business model itself needs a major overhaul.
Hmm.
A great example of this is Netflix. They started out as a DVD rental service, remember?
Yeah, I remember those red envelopes.
Exactly. But they recognized that the market was changing and streaming was the future.
Yeah.
So they made a huge pivot. And now look at them. It's about recognizing when your original approach isn't working anymore and being bold enough to make a change.
It takes courage to make those kinds of big shifts.
It does. You have to be willing to, kind of disrupt yourself before someone else disrupts you.
Right. And I imagine in most turnaround situations, there's a lot of focus on cutting costs, right?
Absolutely. Cost cutting is almost always a big part of the process.
Yeah.
But the key is to do it strategically. You don't want to just slash and burn everything.
No, you could end up doing more harm than good.
Exactly. You have to be really careful to protect those core parts of the business that drive value and avoid cutting things that could hurt you in the long run, like R&D or, losing your top talent.
So it's about being smart and targeted with those cuts, not just making random reductions across the board.
Precisely. And let's not forget about debt. If a company's carrying a lot of debt,
Yeah, that's a big one.
debt renegotiation becomes really important. They need to talk to their lenders, maybe try to restructure the terms of their loans, perhaps stretch out those repayment schedules, or even negotiate to reduce the total amount of debt they owe.
So it's about trying to free up some cash flow and give themselves some breathing room.
Exactly. And all of these strategic and operational changes, they need to be supported by strong leadership and clear communication. It's crucial to build confidence, both inside the company with your employees and outside with investors and other stakeholders.
Yeah, because uncertainty can really breed more uncertainty.
It absolutely can. So you need to project confidence and a clear vision for the future.
Okay, let's talk about some real-world examples to illustrate these points. A classic turnaround story is Apple in the late 1990s.
Yeah, that's a textbook case.
Can you walk us through the key financial aspects of that turnaround?
Sure. By 1997, Apple was in a really bad spot. I mean, seriously close to bankruptcy. They had way too many products, innovation had stalled, and they were just losing money.
It's hard to believe now, considering how successful they are today.
I know, right? But Steve Jobs coming back, that was obviously a huge turning point.
Yeah, his return is legendary.
He made some drastic moves, like slashing the number of product lines they had and refocusing the company on just a few key areas.
Right, he really simplified things.
He did, but from a financial perspective, getting that $150 million investment from Microsoft, that was absolutely crucial.
Oh, wow. I didn't realize Microsoft had invested in Apple back then.
Yeah, it was a big deal. It gave them a huge injection of cash when they desperately needed it, and it helped to stabilize their very shaky financial situation. And, it also sent a signal to the market that even Microsoft had confidence in Apple's future.
So it wasn't just about the products, it was also about getting that financial lifeline and restoring confidence.
Exactly. Jobs also brought this renewed focus on financial discipline. He aligned the budget really tightly with their new product strategy, making sure every dollar was being spent wisely.
So it was a combination of vision and really sound financial management.
It was. And of course, we all know the rest of the story. Apple went on to become one of the most valuable companies in the world. It's a great example of how a clear, focused plan with a strong emphasis on the financials can really transform a company.
It's an incredible turnaround story. Now, another major turnaround, but under very different circumstances, was General Motors after 2009 during that whole global financial crisis.
Right.
What were some of the key financial moves they made in that situation?
That's a great example of a turnaround that happened on a massive scale and one that involved the government stepping in to help.
Yeah, it was a pretty unprecedented situation.
It was. For GM, filing for Chapter 11 bankruptcy, that was a huge but necessary step. It allowed them to restructure their finances under court supervision, and it gave them a chance to get rid of a lot of debt and other liabilities that they just couldn't manage.
So it's like hitting the reset button.
In a way, yes. And then there was the government bailout, which provided them with around $50 billion in funding.
Right, that was a massive amount of money.
It was. But it was essential to keep the company running during that really turbulent period.
So the bankruptcy and the bailout, those were the two big moves that set the stage for the turnaround.
Yeah, they were. But beyond that, GM also had to make some very tough choices. They had to cut unprofitable brands like Pontiac, Hummer, and Saturn.
Yeah, those were some pretty iconic brands.
They were, but they were losing money, and GM just couldn't afford to keep them.
It's about focusing on the core business, the parts that have the best chance of surviving.
Exactly. They also had to streamline their operations, make their manufacturing processes more efficient, and cut costs across the board.
And what was the finance team's role in all of this?
They were absolutely essential. They had to manage cash flow under immense pressure, coordinate with the government officials who were overseeing the bailout, and basically rebuild the company's entire balance sheet.
It sounds like they were in the trenches, really fighting for the company's survival.
They were. And the fact that GM managed to become profitable again relatively quickly just a year later in 2010, and then they went public again with an IPO,
Yeah.
that shows just how effective their turnaround strategy was. It really highlights how important it is to have a comprehensive plan that addresses all aspects of the business: operations, strategy, and of course the financials.
So for someone listening who might be working in FP&A, treasury, or a corporate strategy role, what are some of the specific ways they would be involved in a turnaround situation?
Well, this is where it gets really practical. In a turnaround, your finance skills become absolutely crucial. One of the most important things is creating those stress cash flow projections.
Okay.
You need to model out different scenarios, really understand what could happen, and give leadership a clear picture of how long the company can survive under different conditions. It's about understanding those key assumptions and how sensitive the company's financial health is to changes in those assumptions.
So it's about going beyond the typical budgeting and forecasting, really digging into the what ifs.
Exactly. It's about scenario planning, thinking about the worst-case scenarios, and figuring out the absolute minimum amount of cash the company needs to stay afloat.
And the finance team would also be involved in helping to prioritize spending, right?
Absolutely. Every dollar counts in a turnaround situation.
Yeah.
So the finance team works closely with leadership to decide where to allocate those limited resources, making sure every decision is aligned with the overall turnaround plan.
That sounds like a very high-pressure environment. I mean, you're making decisions that could make or break the company.
It is high pressure, but it can also be very rewarding knowing that you're playing a critical role in saving the company and potentially saving people's jobs.
And then there's the communication aspect, right? Keeping everyone informed about what's happening and why certain decisions are being made.
That's right. The finance team has to be very transparent, explaining the financial situation to employees at all levels. People need to understand the severity of the situation and why those difficult cost-cutting measures are being implemented.
Yeah, without clear communication, it's easy for rumors and fear to spread.
Absolutely. So it's about building trust and understanding across the organization.
So to sum it all up, what are the key takeaways about corporate turnarounds that we want to leave our listeners with?
Well, the main thing is that turnarounds are possible. Even when a company is facing serious challenges, it is possible to turn things around. But it requires a few key ingredients: a clear understanding of the problems, a sense of urgency, and a really strong finance team that's driving the process.
And it sounds like early detection is crucial.
It is. The sooner you identify those warning signs and start taking action, the better your chances of success.
So finance isn't just about crunching numbers, it's about being the eyes and ears of the company, spotting those potential problems early on.
That's a great way to put it. Finance is like the radar, the compass, and sometimes even the lifeboat that helps the company navigate those stormy seas.
That's a powerful analogy. So as you go through your week, think about how these principles apply to your own work. Whether you're in finance or not, understanding how to identify those early warning signs, knowing the key strategies for turning things around, and appreciating the crucial role of finance, those are all valuable insights that can help you in any situation.
Absolutely. It's about being prepared, being proactive, and being ready to lead when those challenges inevitably arise.
And maybe this deep dive has given you a new perspective, a new way to think about uncertainty and those difficult situations. Sometimes those tough challenges can actually be opportunities to learn, to grow, and to build resilience, both personally and professionally.
I think that's a great point to end on. It's about seeing those challenges as opportunities for transformation.
Exactly. Thanks for joining us today for this deep dive into corporate turnarounds.
You're welcome. It was a great discussion.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.